what have you learnt in recent times from Fed speakers? Because we've got minutes later on today, and I'm still, unfortunately, not expecting much out of it.
I think the message that's coming through is that they have no idea what's going on. To be honest, there's a credibility problem in 21, 22.
Yeah.
You know, they felt that inflation was going to actually be subdued, but it got out of control, and then they were chasing that. And now they think inflation's coming down, but it's not coming down fast enough. And I think we've got into a situation where they're coming out saying, be patient, and oh, actually, no, it's going to come down. There's no clear message coming from here, because I think inflation is notoriously difficult to predict. And I don't think they have any real idea of what's happening. And the market, however, is pretty clear that there's only one rate cut that's going to happen by the end of this year.
Fascinating you say that. So I agree with you on your first premise. It's unarguable that it's very, very difficult for them to gauge when to cut or when inflation is going to get to a level where it's sustainably at low levels, so they feel that they can move out of restrictive territory. But the market has done something amazing, I think, in the last 6 to 8 months. It's gone from thinking we're going to get 6+ rate cuts to maybe none, possibly the one, maybe if we're really lucky 2. And it's taken that with such unbelievable composure. It's almost like unheard of for the market to be so composed.
Yes, the market has repriced as well. There's absolutely no doubt about that. But I think the problem is that everyone is trying to extrapolate from a particular direction. Now, inflation did start coming down, but then it seems to have just got stuck at around 3.5%. And everyone's is struggling to find a narrative to why has it got stuck at 3.5%. And I think that's the challenge at the moment. But the stock market is pretty indifferent. It seems to be able to live with this sort of slightly sticky 1.5% above target rate inflation.
So how has that happened? This is a market which is hair trigger. I mean, you remember? You might not because you're too young. But like I remember the days when we had Caroline Roth, who's on the next show later on today, standing outside an ATM near Nicosia or somewhere, where the market was on a hair trigger for ATM withdrawals out of Cyprus. Now we're not getting rate cuts from the world's largest central bank. We don't seem to care. It's amazing.
I think it's because the mega caps, something's changed amongst the mega caps, and it's the high cash levels. If you look at Alphabet, for example, they have over $100 billion of cash. So imagine if that $100 billion of cash was invested in short-term treasury bills, they'd be making $5.25 billion a year doing nothing, just for free. And that really makes mega caps into a sort of structured product whereby if rates come down, it's great for the revenue, the net present value of the revenue goes up. If rates go up or they don't come down as expected, it doesn't matter because the cash levels mean that they're making this huge amount of money on an annual basis risk-free. So mega caps, and I hate to say it, but they've become this sort of all-weather type structure at the top of the market. And I think that's changing the dynamic.
That worries me. Tails you win, heads you win. That worries me a little bit.
Julian, I mean, if I can still ask another interest rate question. Atlanta Fed President Bostic said the efficacy of monetary policy may be weaker than in the past. And I found that interesting because that just means whether we're in restrictive territory or not, that's not necessarily the only thing that's going to move interest rates lower, because that's what used to be the case, right? At these levels, you'd see inflation drop quite considerably. Why has it changed so much?
Well, I think one of the issues is that financial conditions are not correlating with the short-term interest rates. So short-term interest rates, 5.25%, that should be painful. But if you look at financial conditions, particularly, say, investment-grade spreads, they're at about 1.5%, above the US Treasury yield. You look at junk bond spreads, they're at only 3% above the US Treasury yield as well. So there's still a wall of money out there which is chasing cheap financing. You've had the S&P doing well because of AI. So on a lot of metrics, things are actually pretty good. And the 5.25% interest rate just isn't creating any pain. Probably the only sector where it's creating pain is real estate, actually.